David Burrows is our guest at Barometer Capital. We want to get right back to the phone lines. Mike in Windsor, where did you go? We were going to talk to you, but you left us. So Gary in Langley, BC, you are on the air. Good day to you, sir.
Hi, Michael and David, and happy Easter to both of you.
Happy Easter.
The question I have is on BMO Bank and the banks in general, David. What's your view on the banks? Do you see as a buying opportunity, or would you be holding or selling? Thanks very much.
So, Gary, for watchers of Market Call, I've done this for a number of years, and really since 2007, we were quite negative on financials and specifically banks. While Canadian banks are probably better than most of the world, we were quite negative. The main reason was a slowdown in the growth rate and a difficulty generating a strong return on equity going forward and dividend growth. One of the comments we made was these are likely to trade a lot more like utilities going forward than the banks we know and love. The reality is we are now in a market where trading like utilities is not such a bad thing. We have a universe of investors who have an almost insatiable appetite for yield, and the banks, having globally been working at rebuilding balance sheets, are now at a point where their balance sheets are very strong, and as there is a lack of loan growth, the capital is building quite quickly, and you're likely, we think, to see dividend growth more significant going forward than we have seen over the last few years.
We've got a related call then. Let's bring Jerry from Ottawa in on the conversation. Hi, Jerry.
Hi, thanks for taking my call, Michael.
You bet.
Right. Hey, nice to hear that it's on my dime back.
I keep getting complaints it's not a dime anymore. What's your question?
Yeah, it's about any stock that has a sustainable dividend, preferably monthly, in any sector, and I'll leave it at that.
Okay.
Thanks, David, for taking my call.
Okay. So this is a very important point to make because we spend a very substantial amount of our time focused on generating yield because that's one of the major strategies we run is a hybrid yield strategy. And when you go back and do research over time at what works in dividend investing, it is not looking for the highest dividend, right? It is something that's important, and in periods like 1966 to 82, where the market chopped its way sideways for 16 years, or like the period we've just been through, 2000 through present, dividend winds up being close to 100% of the return you get from your equity investments. So it's very important. But the ones that really make you money are the ones with a reasonable dividend, but where there's dividend growth. And we're going to talk about some today. So I would argue to almost anybody, you would be much better to look for a 3, 4, 5% dividend with double-digit dividend growth than to look for 7 or 8% dividend yields, which many people are spending their time looking for, that may or may not be sustainable. And second, will have a very difficult time growing over time. So I think that there's lots, and we'll talk about a couple of names today I think you could look at for dividend yield. But that's an important distinction to make.
All right, Jerry, stay with us. From Ottawa now to Toronto. Dave, last word to you, sir. Maybe not. Dave, are you with us? Okay, Dave's not with us. Oh, hello.
Hello there.
Welcome to the program. What's your question?
It's on AltaGas, and just David's last comments is exactly the position I'm in growth, and I have a long-term time horizon. What's David's thoughts on AltaGas?
Okay, 4.5% dividend yield.
So look, Dave, this was one of our top picks the last time I was on. AltaGas is a big position in our income strategy. This is the interesting part. AltaGas, in its mix of businesses, has a pretty predictable revenue stream. But because of some of the growth opportunities in midstream energy infrastructure, you're seeing a secular advance in the growth rates. And the ability to grow dividends is significant, like to the extent that AltaGas could triple its cash flow over the next 3 to 4 years. So you're going to get that 4+% dividend yield, but we think you can get 7 or 8% dividend growth a year going forward, which is a really compelling combination. So this is one that I would put in almost any portfolio right now.
All right. Now, the phrase, it's on my dime, isn't the only thing that's back now that I'm hearing. You know what else is back?
What's that?
The Market Call Minute. All right, for Steve in Ottawa, Diageo, buy, sell, or hold?
In the world of have and have not, consumer staples is a group you want to be in, dividends plus dividend growth, especially with a global focus.
All right, for a viewer in Kelowna, Starbucks, is it a buy, is it a sell, is it a hold?
Big holding for us, great cash flow growth, growing dividend over time. This is one you want to own.
All right, we lost Mike in Windsor, but he's in the Market Call Minute on Kinross Gold. Is it a buy?
Weakest stock in the group, I would avoid the stock.
For Marcel in Calgary, Primaris REIT, PMZ.
PMZ, great assets. B retail, this is one that is going to continue to do well, continue to have distribution growth.
Linamar for Lois in Edmonton.
So we like auto parts. Small incremental change in employment and housing mean probably spending in pent-up demand areas like auto. Linamar has lots of capacity, can grow the earnings.
For Pratt in Calgary, TransAlta, buy, sell, or hold.
Weakest company in the utilities group, I would far rather own Enbridge.
And Kiera for Jean in Calgary.
Of the energy infrastructure companies, this one has some gas exposure, so you want to be a little bit careful. Stocks come down, I would avoid it and go to other names.
All right. Thank you for your calls, your email messages as well. David Burrows of Barometer is our guest, and when we come back after the break, we'll find out what his top picks are.